So let's do a recap of the greatest investment opportunity in a decade. So let's talk about that.
Yeah. So if you haven't watched it, I would encourage you to do so. The quarterly edge that we put together for the first quarter of, or maybe it was the second quarter technically of 2024.
Earlier in 2024.
Yeah. I called the bond market on a domestic basis today a once in a decade investment opportunity.
Once in a decade. That's what I was looking for.
Right. And so, part of the reason behind that is just because all of the signs were pointing to some massive tailwinds for the bond market. That included currently high interest rates, great potential for lower interest rates going forward, which can be beneficial for prices of debt instruments. And so what we've seen since then is a massive rally in the bond market to the tune of about 7%, as represented by the Bloomberg U.S. Aggregate Bond Index, between the months of April and close of business yesterday, which was September 16th. So the whole argument there was take advantage of the higher rates, get exposure to potential price appreciation as well, and your total return should be good. So if you look at the value proposition of the bond market versus money market funds over that period, the actual kind of yield or the income distribution from the domestic bond market as represented by this index was about 4%, but the total return was 7%. So you can see that there was 3% roughly worth of price appreciation. Now, the argument against this was, why would I do that when I can collect, 5+% on money market funds? My argument was still, look, you're giving up some level of income distribution on a monthly basis, but you're getting it more than made up for, or you're being more than fairly compensated by the prospect of price appreciation. Yeah. And that has been the case.
So there's two things. One, when I think about the price move since April, it reminds me of the comment you made on utilities, where price reacts before the news. And so we saw a price movement. But now that price has moved, and you can see on the chart the discrepancy between the money market total return and total return on bonds, is it too late? I mean, is it too late now for investors to get on the bond train from money markets if they're sitting in a money market position?
The short answer is I don't think it's too late. The value proposition is still there, but it's just a little bit different. And so I can use the analogy of, if you think about going to a wedding and you're an investor that has not piled into the bond market from your money market fund allocation, you might have missed the cocktail hour, but I don't think you've outright missed the reception at this point. And so what I'm saying that is because you still are getting a good, attractive yield opportunity in the bond market. And that's especially important to consider when you think about the direction of money market fund rates going forward. We've talked about what happens to money market fund rates in a declining interest rate environment. I think the best way to look at that is to look at some of the securities that are basically comprising these money market funds. And that's very short-term treasury bills. And so if you look back through history, on the screen, I'm just showing a 10-year snapshot of the U.S. 3-month treasury bill and a money market fund. You can see that the current rate in the market for a 3-month treasury bill kind of precedes money market fund income distribution rates by 3 to 6 months. So if you look at what's happening now, 3-month T-bills are declining. From a rate perspective, that's because the market is looking forward to the Fed, which is poised to cut rates. And what's going to follow that? Deteriorating money market fund income distributions. Yep. So I don't think that you've entirely missed the party. And certainly if there is further economic softness, then you still have an argument for price appreciation in bonds as well. But I think that taking advantage of yields where they are today, potentially locking them in a collection of bonds or some smattering of debt securities, I think still makes a lot of sense. And if you look out over the next 2 years, still very well may provide you with a more compelling income proposition overall relative to money market funds. And I still believe that it'll provide a total return proposition that's well over and above money market funds, from here.
I agree, because this is the beginning of the loosening phase. And so I think right now futures have the Fed cutting maybe up to 10 or 11, 25 basis point cuts over the next, call it, 12, 13, 14 months. So it's beginning now. And that doesn't mean that that's exactly how it plays out, but that's how the bond market is pricing the Fed to cut rates moving forward.
Yeah. And, let's be very clear when we look out over the next year to have 10, 25 basis point rate cuts priced in, or expected, I should say. I mean, I think that's crazy.
And just to clarify, so 10, 25 basis point cut. So we're talking about 2.5% off a Fed funds rate today of 5.5%.
Right. And so, I mean, in that scenario, your money market fund rate over the next year and a half goes to 2.5%, right?
Right.
And so that's just another supplemental argument to what we just talked about. Now, what I would say is that, again, I don't think we're ever going to get to that level. I mean, this is the same futures market that coming into this year expected 6 to 7 rate cuts.
Right.
We've kind of clawed back, and the market's now expecting closer to 4. But whether or not that comes to fruition, I guess the point is, I don't think 10 is going to happen, but I don't think 10 has to happen for this whole bond argument to work.
Yeah, the point is that money market rates are coming down, and the lowering of yields provides an opportunity for capital appreciation in bonds. And so if you can lengthen duration, buy a bond and lock in some duration, that's going to suit you well in that, call it safe haven portion of the portfolio.
Yeah. And the thing is, I think people would say, oh, I've missed the boat because treasury yields have fallen so dramatically that now the 10-year is at 3.6%. I think I definitely missed the boat. I think this is about a lot more than just treasuries, especially if you kind of venture out and look through some segments of the corporate market. You still have really high quality paper that is providing you with a spread above treasuries that should be viewed as pretty attractive. And keep in mind, even if we get some economic softening, if we were to go into a recession, I don't view it as being overly punishing. And so some of these businesses that are issuing the high quality paper that I'm talking about, I still think the value proposition is maybe even better there than it is in the treasury market.
Yeah. That's interesting.
Yeah.
Great stuff.